Joining me here at the conference, Dave Sekera is the Chief U.S. Market Strategist at Morningstar Research Services. Dave, good to see you again.
Good to see you.
So we're talking about today in the short term, there's like this bid happening into cloud companies that generally have been underperforming, all the hardware stuff. But it makes me think of one of the lines in your notes, which is that the AI trade, these plays may have run their course. Tell me more.
We think so. When we look at the AI plays, now a lot of these plays were 4- and 5-star rated stocks, a year and a half ago coming into the year. They've moved up so much, and we've even moved up our fair values in a number of instances, in some places, quite significantly. But at this point, they're at best fully valued, and at worst, many of them are becoming, overvalued and now 2 stars. So I think now is a good time really to start moving away from the thematic trades that have worked for the past year and a half. Start looking more for idiosyncratic plays, individual stocks where they're still undervalued. Now tech overall is trading about a 10% premium to composite of our fair values. That's getting pretty far into overvalued territory. So I think it's a good time to underweight the sector, but there are still interesting plays. Adobe and Salesforce are actually 2 4-star rated stocks, both that I'd recommend investors to take a look at today.
So companies in those 2 cases that have kind of had a murkier AI narrative, will it help them, will it hurt them? Ultimately, it seems like the valuation is playing a pretty big role in your call here, that it's maybe not going to hurt them as much as the market has thought.
Well, I mean, both of those are a little bit more story stocks, in my mind. So if you remember, first quarter when Adobe came out, the stock got hit pretty hard.
Yeah.
I think management had a hard time really conveying, their sense of guidance, and the market just didn't like that. So the stock sold off. We revisited our model. There was really nothing at that point in time that caused us to change our assumptions. So we held our fair value, and now we're starting to see that stock, come back up. So I think that's a good one with some good momentum behind it.
Okay.
And again, taking a look at Salesforce, that's just a phenomenal company. It's got some of the best margins, within the space. We just see a long-term growth trend there that I think has still got time to play out.
Ultimately, it's never really worked to bet against Salesforce and a Benioff and team. For stretches, it has. It's been volatile at points, but ultimately it's always come around. To kind of go back to the point of the AI plays going from 4 to 5 star to 2 or 3 star from your guys' ratings, that gives, I think, a little bit of insight into the role valuations play within your ratings. Can you elaborate a little bit? Because, I mean, it's not like the companies got worse, right? They got really expensive, some of them.
Yeah, and again, overvalued stocks can always get even further overvalued.
Right.
Now, I'm really interested to see what happens with PCE when that comes out tomorrow and how the market reacts to that. But having said that, if PCE tomorrow comes in kind of in line or better than expected, I think we're in line for kind of that next 3-week market melt up. But as far as valuations go, again, I think it's time to get away from the themes that have worked and really look for those idiosyncratic stock picking plays, really getting back to the basics and the fundamentals, looking at those sectors like real estate. Real estate's the most hated asset class on Wall Street right now. I'd still steer clear of the urban office space, but those real estate plays with defensive characteristics, medical offices, research facilities, triple net providers, they all look really attractive to us. Ventas and HealthPeak in the medical space would be 2 that we like. They're 5-star rated stocks, trade at over 30% discounts to our fair value. Both pay very good, healthy dividend yields. And then in that triple net lease space, I think you'd need to take a look at Realty Income. Again, 5-star rated stock, 30-some% discount to our fair value. I think over a 6% dividend yield to earn while you wait.
So you find that kind of combination of income, but also maybe a secular trend that keeps them more insulated, gives them a moat. We're looking at some of your sector breakdown here for the valuations, also the nature of the overvalue being much more geared towards tech. I mean, a lot of stuff is either fairly or undervalued. You just took us through some of those sectors and the names that you like. But it looks like you get out, 4 sectors out of 11 only overvalued. That's not that bad. It really speaks to the concentration of the market that's pushed up the index valuation, right?
Well, it's really interesting. So if you look at 2Q results, through, I think, Monday when I ran the numbers, if you didn't have 5 stocks in our index, so if you didn't have Alphabet, Amazon, Apple, Microsoft, Broadcom, if you pulled those 5 out of the index actually would be negative through this quarter to
amazing.
date. So if it wasn't for those 5, it'd be a different story in the marketplace today.
So reading kind of between the lines here, tell me if I am too much, but when you talk about the stuff that's driving the index is being overvalued, but the possibility that a cool inflation print could bring a melt up, is that kind of telling us that at this juncture you have to have a macro component to the rally? Because if we kind of call this year so far a secular AI-driven rally, because we've been dropping the number of cuts, it hasn't mattered. Does that mean that we're now at the point where you do need some macro assistance for further frothing?
I think it's just a matter of that we just really need to see, the returns broaden out into the rest of the market, go into those areas that are undervalued. So I think really kind of the next big thing to start worrying about is when 2Q earnings come out in 3 weeks.
Okay.
Now, I'm not worried about 2Q earnings. I think the economy's been strong enough. There shouldn't be too many misses there, at least certainly not more than what you see usually. My concern there is, depending on how fast the economy is starting to slow here right now, will management teams reiterate guidance for third quarter and for the second half of the year, or are they going to start pulling in some of that guidance?
Okay.
So right now, the market overall is trading at about a 3 to 4% premium above a composite of our fair value. So that would put it in the top of the range that I consider to still be within fair value, but it's getting pretty close to being that overvalued space.
Okay.
In fact, since 2010, it's only traded at this much of a premium or more, like only 10% of the time. So it's pretty rare occurrence that we see it up here. So if we do see some kind of hits to guidance, when they start reporting those numbers, I think you could see a bit of a sharp sell-off.
All right, but then the other stuff that's not as expensive, you think that flows could make their way there just kind of by virtue of the quality of their earnings? We don't need some big macro tectonic shift.
It's always about valuation.
Yeah.
So I mean, sectors like energy. I think energy looks especially attractive right now. It trades at about a 7% discount to our fair value. And what I really like about that is we actually have a pretty bearish view on the long-term price for oil. So our team looked for oil in the long term to come down to about $55 a barrel for WTI.
Wow. Yeah, that's a
But
pretty
yet with
bearish
this oil as high as right now, if oil stays here or even moves up any further and stays up there, there's a lot of upside leverage for stocks that are already trading at a discount. So again, stocks like Exxon is probably our favorite play among the global majors, 4-star rated stock. For domestic plays, we like Devon, and for those investors that can take on a little bit more risk but looking for something speculative, I'd look at APA. So they've got a joint venture with Total.
Yeah.
So I think that one's going to be interesting. We do think that they're going to probably move forward with a play in Suriname that they're joint venturing with Total on. We expect that to be announced later this year, and if so, there's a lot of upside left in that stock. I think it trades about half of our fair value. Worst case scenario, if they don't move forward with that, our team still thinks it's trading at fair value today.
All right, great stuff, Dave. Love the knowledge, love the interweaving of the stock picks into the macro, and our final Morningstar guest of the show for the last 2 days, so a really fine way to display your guys' base of knowledge there to close things out.
Well, thank you, and thanks for coming to our conference.
Absolutely, appreciate that very much. Dave Sekera, Chief U.S. Market Strategist at Morningstar Research.